Hey folks, just a reminder, these trades are done in a simulator. It's important to understand the limitations of hypothetical results. Make sure you read that hypothetical risk disclaimer you see on the screen. If you have any questions about what it means, please feel free to contact us. You can email trade@infinityfutures.com with any specific questions. Thanks again. Hey everybody, good morning. It's about 7:15 on October 15th. Thanks for watching today. So I was looking at crude oil this morning, and I just want to zoom in a little bit here and show you what I was thinking with this idea. So you haven't really seen me talk about MPD lines in the context of crude for a while. I used to do this sort of as an ancillary idea to the stock market ideas. And what typically happens with the MPD lines is that as markets get more volatile and more trending, they become harder to trade in a counter trend way. It's just reality. So what I often will do is when things get really crazy with the stock market is I'll start looking at other products like crude and gold and the yen and some other ones. And so a lot of times with crude, you'll see these big flushes in the morning. And I don't know if there was news here or what happened. Sometimes it's just an algo firing off or something. But look at the depth of the book on crude. You can see that it's mostly in the low double digits, sometimes higher. It doesn't take much for crude to get running because once a whole bunch of orders start firing off and other algorithms and systems start seeing that, it becomes really quick to pile on. And because of the lack of depth to the order book, it can really get going. So if you see the market break like this, especially early in the morning, a lot of times you will see some kind of a reversion as long as this is not a gigantic news event like what we saw with the oil, the attacks in Iran a little while ago. And so you see here the market breaking through the lower MPD lines. It kind of just breaches and breaches and breaches, and then there's a bigger breach. And this is the one that I was looking for. And I actually said, okay, this might be a good opportunity for a counter trend trade. Just looking how fast the market was moving, it just looked like it was all algorithmically driven. It looked like it was wild, and I was thinking, there's a pretty good chance there's some kind of reversion based on the way this looks. And so that's where I bought one. So this is a hypothetical trade long from 52.52. You can see that that's the green line on AT charts that's showing me the position. And here's what you basically have to think from a risk standpoint. So if you're going to do a trade like this and you're in the typical range of willing to risk, let's call it like $400 to $600 in a day, this might be your only trade of the day. And that's because that there's a good chance if it is really super volatile or super thin, if crude does continue to come down, you really got to give this thing 40 or 50 cents. And from 52.52 to 52 even, that's 52 cents in crude, $520. I mean, that's not chump change. So you have to be accepting of the idea that if this really breaks against you, that might be it for the day. All right, so be it. But in this case, we did see a pretty strong reversion back to the mean. And so here's how I would hypothetically play this and how you can incorporate something to help you with stop placement. So once you realize that the market has turned a little bit, I would say that once you get in, 100 maybe $200 in your favor, which is 20 ticks in crude, if you're really worried about the trade turning into a loser at that point, maybe you think about putting your stop at your break-even price. But you really don't want to do that until you get something that's 200 or 300 bucks in your favor. Otherwise, you're always going to strangle it too quickly, and you'll never catch something that really runs. So in this example, I had to stop at my break-even price at 52.52. Okay, 52.52, which is right here. Now, one thing if you find something that is working, one thing you could try to use as an add-on to try to help you with your stop placement is the use of this Supertrend study. So the Supertrend study is the combination of these green arrows and these red arrows right up here, as well as the green and the red lines that are associated with each other. It kind of looks like a parabolic SAR, ATR-based trailing stop type deal. And this is the kind of situation where if you're in a position and it's looking pretty good, and you see this indicator confirm the uptrend, at that point you might say, okay, now I tighten things up a little bit. But how tight do you tighten the stop up? Really, I wouldn't give it any more than a couple $100 of a locked-in gain. So I move the stop up in this case to 72. If the market were to stop me out 72 at 72, that's a 20-cent winner before commissions. That's $200. That to me is enough. Now we're in a trade that's up 760, hypothetical dollars here. So why do I want to take more of that? Well, I mean, I really do, but again, there is this tendency among retail traders to really cut these things off way too early. And I think in this scenario, your best bet is to leave the stop at 72 and take a hike and maybe come back in 2 or 3 hours because there's really only one of three outcomes. Okay. One of them is you're stopped out. The other one is the market hasn't done all that much. It's either up a little bit or down a little bit, and you have either a pretty good sized gain or a modest gain. And the third possibility, which these days is equally as likely, is this thing is through the roof. And now you're in a trade that makes your week or your month. And how are you going to catch one of those if you micromanage it the whole day? Okay, it's just really unlikely that that's going to happen. So the MPD lines are something that it caters to the reversion to the mean style trader. They don't necessarily only apply to the stock market. The lesson here is that when conditions change, you have to be nimble enough to realize that, look, some things are going to stop working for a little while. The key is to be judicious enough with position sizing and risk where when that happens, you don't blow the account. You can take a loss, you can take a series of losses. Mathematically, it's got to be possible for you to recover without adding funds for the strategy really to be viable. Because there's going to be scenarios where what you're doing just stops working, just and no fault of your own, even if you're following all the rules. So when I saw the stock market really start to get crazy over the last couple of weeks, I sort of pared back my videos on the MPD lines because I was thinking, you know what, there's just to me, there's not a lot of opportunity here. I mean, you could put some orders in really far away from the market. You could use these micros to scale into these sort of tiny positions. It just wasn't worth publishing content on. You have to be conscious of the idea that those things are going to adjust, and sometimes you have to look elsewhere. And so this is an example of that. So crude, I would say you want to be more careful with it during regular hours. Off hours like this, it just really felt jerky and algorithmic, and it just looked like everyone was overreacting. And you could just kind of tell by looking at the order book just how quick it was moving that this is all just felt like nonsense, and there's going to be some kind of reversion back. And that's what drove me to put the trade on, which I did manually, at 52.52. So you can see the position here at 52.52. On the charts, we can see a summary of the open orders. I've got the stop in at 52.72. You can also see that right here as well. So if we wanted to modify it or something, we could do that right from the screen. I'll just leave it back, where it was here. But it's a really easy interface, for those of you who are unfamiliar with AT charts and more used to other charting packages. To me, this is kind of a good example of how easy these things are to manipulate, but not complex, really simple, relatively simple idea. The use of a add-on in the form of the Supertrend study as kind of like a assistant for stop placement. I think that's probably the way that I would best characterize that. If you find yourself kind of wondering what to do or looking for some direction with respect to stop placement once you get into a trade that is starting to work in your favor, man, if you're long and you see that the green arrows show up here under the super trend, that's a good sign that you have something you might be able to stick with for a while. But that's not an excuse to strangle it, or micromanage the trade too closely. All right, so we'll pause it for now and come back in a little bit, see how things shake out. Hopefully things keep running, maybe not, but as far as I'm concerned, this is it's a great example of the MPD lines in a non-stock index indicator or market rather, and something that we sort of have a free trade on. So we'll see what happens. Thanks for listening. Good morning again, everybody. So just a few minutes later, it's about 7:32. The market kind of made another leg up here. It's now trading around 53.42, and it put in a high, just in this last few minutes of around 53.50 or so. And what I'm thinking here is just given the straight line nature of this move, I think it would be prudent to tighten the stop up a little bit. In this case, I might say we move it up to slightly under that VWAP area. So if it does come back a little bit, that we're not gonna necessarily get tagged out, but if the market really rips lower, we're not gonna give back too much either. So 52.98, this is probably where I would leave it for like the next 2 or 3 hours. So I'm not even really gonna look at this again. This might be the last um, video in this little series here because again, this is the sort of thing where we're either going to get stopped out and realize a significant gain. Okay, we're long from 52 all the way to 98. That's a great trade. Or, we're going to come back around the end of the day and the market's going to be kind of where it is now or maybe a little lower or a little higher. And we either have a really good gain or a pretty modest gain. Or who knows? I mean, maybe we're above 54 by the time I come back and look at this thing again. So uh, to me, it's a great example of the use of patience and not, strangling the trades too early. It's a great use of the idea that these MPD lines can be applied to other markets. It's all about context. And again, we're looking at crude, again, because of my sort of pensiveness related to the stock market, because even though there hasn't been a huge range overnight tonight, I mean, it has been decent, I guess, about 16 points or so. Things are really happening quickly in the stock market these days, and I just don't want to get caught on the wrong side of something, too early. So we'll see. There might be some other opportunities in the equity indexes. We'll see how that plays out. But in the meantime, hopefully you enjoy this presentation. Hopefully you're getting some use out of it. It's good use of the examples of AT charts and how quick and easy the program is to use as well. Remember, you can modify your orders and place trades and such directly from the chart. Really easy, communicates nicely with the DOM. So hopefully you're seeing that. If you have any questions, just give me a buzz. You can reply to any of our email or call me at 312-373-6228. That's my direct phone line. Be happy to hear from you. Again, Patrick from Infinity. Hope you enjoyed it. Thanks.